protectionism, populism is a passing phase. He went on to say that this is also because there is another political trend globally, which is very strong mass leaders. Therefore, whether it is Trump in the US, whether it is the Chinese president, whether it is Russia, whether it is Turkey, whether it is going to be in many parts of Europe and the UK, and of course in India we have a great mass leader in our Prime Minister Narendra Modi. But is that also a part of a different narrative globally than what we have seen earlier? And is that again a passing phase or a mega trend? This is the other part of this equation which we need to ask ourselves. Fareed's view is that this is the trend about economic trend, he believes, which is protectionism and anti-globalization. He believes is a short-term trend, and even the mass leaders will recognize the value of free markets, free trade, free immigration, and they will move to a policy which is back to open markets in a period of 3 to 5 years. But this, friends, has major, major implications on global economics and, more importantly, on India. Turning to India, friends, India has been a huge beneficiary of globalization. Our software services industry, which started in the late 90s with zero, is today a $110 billion export item from zero. A $110 billion export item. And this would not have existed unless we were a part of Megatrend 2, which is free markets, free movements of labor, free exports. Now, is this industry going to face the challenge? Similarly, the pharmaceutical industry. Similarly, many other areas of trade. Are we seeing a risk to India's economic model coming out of global protectionism? My view is it hurts India on the margin, but one of the advantages which India has is a very large domestic economy. Therefore, in the context of India, I do believe even if this Megatrend 3 does develop, India has the sustainability of being able to continue to grow and sustain, albeit slower than what we think we can. Because IT will be affected, and certainly pharma. These are two industries which will be affected. And that brings me to another extremely important point, friends, which is on top of people's concerns, is because of the change in the world order, including dramatic growth in digitalization. The key issue in the world is, where are the jobs? Where are new jobs going to come from globally? And that question is even more relevant in the Indian context. India needs to add 12 million jobs to its workforce. And where are the jobs? And I was just having a chat with the now famous CEO of Infosys, Vishal Sikka, just day before yesterday in Mumbai. And just to give you one statistic, Infosys as a company, last year, that is 15-16, added 15,500 jobs in a year. 16-17, Infosys will add 5,000 jobs in a year. So there is a 66% drop in the number of new jobs created by the bellwether of IT. And there is a view that the IT industry will effectively stop creating new jobs as we go into the future. Currently, on an annual basis, the IT industry creates 250,000 jobs every year. And from that, you're going to see a number which is anywhere between 50,000 to 100,000 new jobs at best. So 80% drop in the number of new jobs by just one industry, which is IT. Therefore, at a time when we have got a rising population, which is coming into the workforce, and with the changes in technology, including digital, it is a pretty significant change. I'll share with you something in banking alone. As you know, we are going into this whole digital era, and I'll talk about banking since the lecture is on banking as well. In banking alone, friends, thanks to moving to digital, which is We can open a customer's account based on biometrics instead of getting all the physical data. Banking alone will reduce its demand for new jobs in the next year or two by close to 100,000 jobs a year. And every player in our industry is focused on improving productivity and effectively what I would call as jobless growth. So in this context, friends, I think the larger question which we need to ask, including as chambers of commerce, is for all that we are doing, where are the new jobs going to come from? And how are we incentivizing these new jobs? I was happy with the finance minister's announcement of saying 25% tax for all companies whose turnover is below 50 crores, even if it goes above 50 crores, because that is a signal that we want small companies to grow, add jobs, and become big. But is that enough? My personal view is we need a lot more to be able to add jobs to the Indian economy and the Indian workforce. At a time when Mr. Trump and various other leaders around the world are saying, don't come to our country and do not steal our jobs. So the new jobs are not coming from the rest of the world. We will have to create new jobs for our people in India. And that brings me, friends, back to the heart of banking and finance. It is a subject which is a subject matter of great debate right now in terms of the future of banking. I was just doing an internal meeting and I told my team that we need to think the way Steve Jobs thought about Apple. Many of you may be aware about Steve Jobs' famous speech at Stanford University, where he said that there is one thing which is certain, which is death. And Jobs was down with cancer. He knew that he's not going to live very long. And he took the call that I want to make the iPhone before I die, because that will be the legacy I will live with. So if he saw death as a certainty individually, what I told my team is, why don't we think about the future of our institution, say hypothetically, as 5 years? And what are we going to do in the next 5 years which will transform us to avoid death? And assume that you have 5 years to go, whether you are an individual or an institution, and think about end of 5 years, it's the end of it. And create a paranoid mindset to change, because if you don't change, you will be out of business. And Deepak was referring to many global companies. I have seen Amazon at close quarters. In 2001, I met Jeff Bezos, and he was competing with a books company called Barnes and Nobles. And people were debating who's going to win. Inevitably, Amazon basically killed Barnes and Nobles, which was closed down. Today, 15 years later, he's now eating Walmart's lunch. Walmart was one of the largest companies in the world and is now facing the heat of Amazon as a company which is effectively eating Walmart's market share in organized retail. And this, friends, is the change. The change is happening at a very fast pace, and banking and finance is no exception to it. And when I think about this change in digital, I think digital is going to change the way we do business. And we are seeing a huge growth in our digital adoption, but I feel we are still moving at a tortoise pace. And I think digital is going to take away a very significant part of profit pools of banks and financial institutions, which is what I call as transactions. However, the area where I think banking and finance will continue to have a long, sustainable role is in the area of risk management and knowledge and skill. Therefore, if you go back to history, banking came into being because somebody had surplus, somebody wanted money, and the banker was able to manage the risk in the middle and make a spread for it. I think that function of banking will remain at all points of time, whether it's the start of time, whether it was the start of Dena Bank, or whether it's the future of Kotak Mahindra Bank. I see the continuing risk function and the intermediation function between the borrower and saver continuing for a long, long time. The other area where I think financial services has to really grow is the area of knowledge and skill. What is knowledge and skill in the context of financial services? Many of you put money into mutual funds. You put money into mutual funds because the fund manager is managing your money and producing superior returns. Now, you could put money, instead of a mutual fund, into a ETF, which is investing only in index or index stocks. How does a fund manager outperform the ETF for making money? An ETF's management fee is 1/10 or 1/20th of the management fee of which a mutual fund charges. Therefore, if the mutual fund does not produce superior returns to an ETF, and this is happening in the US, people are switching money into ETFs from mutual funds. And mutual funds are actually losing out in the US. On the other hand, in India, mutual funds have outperformed the indexes, which is why mutual funds in India continue to see a lot of new money, and the industry has grown 30% in the last 12 months. Therefore, friends, I do see banking and financial services at a cusp and in the middle of a major mega trend change, which is digital is going to be a challenge and an opportunity. Good risk management will continue to be the core of banking and finance, and knowledge and skill is going to be the bedrock, or else we will be out of business. And in that context, there is another very important aspect which we need to keep in mind. That is the 70% problem. 70% of India's banking is still with state-owned banks, the public sector banks. The very banks which the government of the day, nearly 50 years ago or 47 years ago, nationalized. 1969 to 2016. And which of us is ready to ask the question, how is it that taxpayers' money over this 47 years been used by a system which is now 70% of the financial system? And on this very august occasion, which is the Pravinchandra Gandhi lecture on banking and finance, I'm raising the question that where and who is asking for accountability of taxpayers' money, of public money, which has been poured in for the last 47 years, when a decision was taken by the then government in the public interest and national interest, and who is measuring that even 47 years later? I think there is, if you ask anybody, whether it's chambers of commerce, whether it's business, whether it is regulators, whether it's government, no one is prepared to ask the question, what is the future of state-owned banking in the Indian context? India is amongst the few countries in entire Asia, with the exception of China, where percentage of state ownership in finance is amongst the highest. And we have liberalized in many, many areas, but this is one area which is effectively an area where the system is not ready to make the change, irrespective of different governments. And I would really request the Indian Merchants Chamber on this occasion, with one of the founding members of one of the key original founders of the development of the IMC, Praveen Bhai's family and the IMC, to now at least ask the question and have some level of accountability that huge amount of public monies are involved with the state-owned banking sector, and how we will change their futures and our futures to a more productive and developed economy. The time has come, friends, because the pace of change, the needs of the economy, and the digital revolution which is on us require us to ask this question, because otherwise we as business will not have the ability to be sustained by a banking system if 70% of the banking system is facing just such huge challenges. Of course, on behalf of us as bankers and as players in financial services, we would do our best to see where we can step up on the plate and add value and provide service to the entire customer base, in particular the business community, which is the core of Indian Merchants Chamber's core membership. With that, friends, I just wanted to end by saying that we are at the cusp of a potential megatrend 3. I do not think megatrend 3 is something which India should succumb to. India must avoid protectionism, India must avoid populism, and India must embrace free trade, free movement of people, and true globalization, because India will be a huge beneficiary of these traits and not fall prey to what many other countries are doing. And we as a people must have the confidence now, after so many years of liberalization and globalization, that Indian business has the power and the courage to stand up and be better than the best in the world. Thank you very much, ladies and gentlemen.
That was enthralling indeed, sir. It was fascinating to learn about the mega trends that shaped the new world order. Thank you for your thoughts.
Audience, let's keep the ball rolling because it's time now for a question and answer session. We would request Mr. Deepak Prem Narayan, IMC, to conduct this session.
Thank you. Hello. Before I throw it open to the House, Uday, you mentioned about the situation with the public sector banks. And I think when you launched your bank, you clearly saw that as an opportunity because they were not servicing the market properly and the multinational banks, the foreign banks were not being allowed to expand. So that's a niche that you tapped on. But today, let's look at it this way, that we have a situation where NPAs are mounting. And we've been advocating as a chamber that the country should head for a good bank and the bad bank. What happens is that for the House, is that you take the banks and you segregate the bad assets and you park them into not an ARC, but into a bad bank. So therefore, the good banks will have better valuations. They'll be able to attract international monies, as you said, that we should allow flows to happen. What is your view on that today?
No, I think the first point, I share with you the point that there is a big issue out there which needs to be addressed. Now, there are various numbers which are being thrown around, but close to 20% of the loan books of banks are supposed to be under stress, 20%. And for some of the friends here, I just wanted to go back to ABC of banking. In banking, at an average, the business works like this. I have 10 rupees of capital. I take depositors' money of 100 rupees. So I have 110 rupees. And I lend out 110 rupees. I'm keeping out the complexity of CRR, SLR and everything else. So 10 rupees of my own money, 100 rupees of public money, 110 rupees which I have, I lend out. Now tell me, friends, if out of 120 rupees, if 20 rupees is stressed, out of 110 rupees, if 20 rupees is stressed, what does it tell us? Because we have to pay the depositors 100 rupees. Now, of course, all the 20 is not bad. Some of it will be recovered. Now, if we recover 10 rupees, we are still saying the entire capital is wiped out. 110, out of which 20 rupees is stress, assuming 50% is recovered, 10 rupees is not recovered, the total capital out of 110 is 10. What happens? And this is the challenge. Then, if you have 70% of the system which is state-owned, the state will have to put money. Now the question is, the state has been capitalizing our banks for the last 47 years. So from here where? And assuming we find a solution, is it one more patchwork, or are we going to go to a sustainable solution? And it is here that the question which Deepak asked is, if the banking system is not able to solve the issues of the legal system and is not able to recover monies from borrowers, and friends, bulk of the money is to larger borrowers, how do we get a vibrant, well-functioning financial system? And this is a risk of a moral hazard. If one borrower doesn't pay and is not obliged to pay, it creates a behavior where other borrowers say, why should I pay? So the whole system needs a huge revamp. And in that context, the discussion of a bad bank is being talked about, which means move all the stress assets out of the banks and move them to a new bank which is called the Bad Bank of India, which is capitalized either by private sector or by government. And this Bad Bank of India will do a job of recovery because the good banks of India could not do it. So the question is, who is going to be managing this bad bank? Again, if it is going to be essentially, say, people from the existing banks with a similar mindset, how will you recover money? And we all know the Indian business entrepreneurs are normally smarter than the bankers. So how will the money come back? The danger is we need to have a very solid basis of transferring assets at the fair price to the bad banks, and thereafter having a very strong recovery team which can manage this well and be surgical, logical, and if I use the extreme word, ruthless to recover this money. Otherwise, it is the public money which is at risk. And the easiest thing for any policy maker and any government over the last 50 years has been to take new money from the taxpayers' bill and put it into the banks and kick the can into the future. We are at a crossroad, and I do believe that IMC has to take this position up, because it is also, there is a counter as well. Business and many small and medium enterprises and mid-market companies are not getting new money because banks are scared. And then you have the investigating agencies. We have seen recent developments where a lot of bankers have gone into trouble. And my view on this is that if something wrong has been done, certainly the bankers need to be accountable. But the kind of fear which it creates in the mindsets of the rest is such that no one in many, many banks is ready to take any decision, because you get into trouble if you decide, and you know, particularly in public sector, if you do nothing, you are safe.
We're open for questions. Mike, please. Sorry? She wants to ask a question. So we'll do that now. Yeah.
No, how these bad loans were given. Is it all political loans, or is it graft, or is it...
I can't hear you.
We can't hear you clearly. You're saying the bad loans which are given?
How were these loans given? On what security? Are they political loans, or were people paid off to give these loans?
Security.
Security.
See, again, normally a security for a loan would be either fixed assets or goods, hypothecation of goods and receivables. My experience as a banker, and I'm sure many of you in business know this, most of the time, not most of the time, some of the time, the so-called goods, when you actually want to recover money, don't exist. And on fixed assets, very difficult to sell a factory, land and building which is not performing or producing cash flows. The issue which we have to now think about as lenders as well is, in addition to security, how good is your credit skills to ensure that there is a cash flow based lending, not just based on security. Because at times of trouble, most of the time we find that the security may not be there, and even if it is there, very difficult to sell it. Therefore, we need to move to much higher skills, which is what I talked about, risk and skills required in financial services, to be able to deal with a future where banks and financial institutions can manage the risks of the environment and still be supportive to small, medium and large businesses for building India's economy. And I think there's a big gap there.
Okay, thanks. Devna?
Deepak, can I ask a question?
I'll just come. Devna, I think she wants to complain with the money that she kept with her father-in-law. Just a second.
Hi. It was lovely hearing you speak, Mr. Kotak. Just wanted to ask, it's not digital related question, but regarding, you were talking about domestic consumption, which would help spur the Indian economy in the face of a protection-oriented global economy. But with the demonetization that has happened, the effect of the demonetization, how long would the impact be on sort of the wheels of the economy? We know they're going slower at the moment, but for how long, and how will domestic consumption save the growth?
Okay. First, let me say that as of today, things are better. Therefore, if you go to our bank branch, you'll get money. Okay? And I remember in the early stages of demonetization, we were worried at the branch because, we were getting old notes and a lot of customers wanted new notes. So in the initial stages, the flow of new notes was a little slow. So our managers at branches were very worried, or our managers who were handling ATMs, that how can we tell a customer we don't have money? But most banks went through that period in November and December, where refilling of ATMs was a challenge, and ability to meet the customer's need of cash in most branches was a challenge. I can assure you that now that is back to normalcy, okay? And that is one. From an economy point of view, in terms of currency in circulation, we are fast normalizing. I think the RBI has also announced that by 13th of March, they will remove all, which is I think holy. They're going to remove all the caps on currency withdrawals and everything else. Therefore, from the point of view of the real day-to-day lives, I think we have moved back to normalcy. However, demonetization has made a big change in the business environment. And I'm looking at the macro. It has effectively moved a lot of economic activity from the informal sector to the formal sector. Therefore, a lot of businesses, small, medium, and others, which were working in the informal sector, have found it to be more challenging even in the post-demonetization world. But the formal sector has actually gained. And therefore, if you take, say for example, if you take the jewelry business